They did it once more. Silver's price didn't crash because miners suddenly found massive new deposits underground. The white metal didn't plummet because solar panel production stopped or electric vehicle manufacturing disappeared overnight. Silver collapsed because the game's rules shifted. A collateral requirement increase slammed the derivatives market this morning, triggering automatic liquidations that were swift, brutal, and unavoidable. Last week, silver climbed toward the upper 80s. Then, precisely as speculators returned from their weekend break, the commodity exchange boosted the cash amounts required to maintain specific silver positions. If you held leveraged long positions, you'll awaken to immediate additional collateral demands. Meet those requirements or face forced closure at whatever price the market offered in that instant. That's exactly what occurred. Not some enigma, not a macroeconomic transformation, but a collateral squeeze. Welcome to today's analysis. In this examination, I'll demonstrate the mechanisms behind this decline, the recurring cycle that haunts silver repeatedly, why derivative pricing can swing dramatically while physical markets remain stable, and which indicators deserve attention moving forward. Quick request before we continue. Hit subscribe, simple and straightforward. When the next wave arrives, you'll want those notifications active. Now let's eliminate the confusion and focus directly on the catalyst. A silver derivatives contract functions as a leverage instrument. Each contract controls thousands of ounces, yet you don't purchase those ounces up front. You deposit margin, merely a portion of total value, serving as a performance guarantee. The exchange essentially demonstrates your ability to weather price swings. When exchanges elevate margin requirements, your necessary cash changes overnight. This means your broker recalculates your account using new standards. Insufficient funds trigger a margin call. If you cannot satisfy it rapidly, brokers don't negotiate, they liquidate. Full stop. Now amplify this across thousands of participants. When countless leveraged traders face simultaneous forced selling, orderly price discovery vanishes. You witness a stampede instead. The sell button isn't pressed from conviction, but from necessity. That's why these drops resemble cliffs. Normal corrections feature buyers entering, sellers testing resistance, price fluctuating naturally. Forced liquidation doesn't fluctuate, it plunges until forced sellers finish. Timing always proves critical. This margin boost struck during a thin year-end period when market liquidity typically shrinks. Reduced liquidity means identical forced selling impacts harder. Stop losses trigger more easily. Cascades develop faster than participants can respond. Here's lesson number 1. In silver, you're trading the metal and the leverage rulebook simultaneously. Most traders discover this truth expensively. Let's examine specifics, because margin sounds like tedious footnotes until it invades your account. Two figures typically matter most: initial margin and maintenance margin. Initial represents opening and holding requirements. Maintenance marks the minimum needed to prevent calls. When volatility explodes, these figures can jump dramatically, and when they jump, impact isn't distributed equally. Major institutions can post collateral instantly. They possess credit facilities and treasury departments. They transfer funds within minutes. Smaller traders cannot. Retail participants cannot. Many cannot wire additional cash immediately, particularly during holiday periods when banking slows and approvals extend. Consequently, markets don't liquidate inappropriate crowds first. They liquidate the least liquid crowds first. That's why these episodes feel unjust, because structurally they are. Now observe the chain reaction. Price dips. That dip activates stops. Stops become market orders. Market orders push pricing lower. Lower pricing triggers additional margin pressure. More margin pressure forces more liquidation. It's a self-perpetuating downward spiral. In derivatives, that spiral can represent ridiculous quantities of paper ounces trading within minutes. Not because equivalent metal moved, but because equivalent claims moved. Since futures pricing serves as the benchmark, claims can drag screen prices lower even while physical markets remain unchanged. You can experience a reality where charts scream downward while actual world sourcing stays constrained. That's not contradictory, that's systematic structure. Now, structure doesn't prevail indefinitely. Physical reality serves as the ultimate arbiter. When paper pricing drops sufficiently below physical reality, two developments typically occur. Buyers possessing real capital enter, and arbitrage begins identifying gaps between paper and physical markets. Recovery doesn't always happen instantly. Delivery mechanisms, storage, and financing slow the process, but discounts become attractive bait. That bait draws the most important participants, end consumers, and deep-pocketed accumulators, which raises the question becoming the cliffhanger following every margin flush. Did today's forced selling deliver discounts to precisely those buyers who need ounces, not speculation? If so, today's crash might quietly transform into tomorrow's recovery. That's why leveraged traders need only one defense buffer space. Don't operate accounts at maximum capacity. Don't assume today's margin equals tomorrow's margin. Expect increases when they inflict maximum damage. Without room for such increases, you lack a position. You possess a countdown timer. The official rationale for margin increases is risk control. Volatility rises, margins follow. Exchanges must protect themselves and members. That explanation holds validity. Exchanges genuinely require protection. But here's lesson 2. Risk management and price impact aren't separate concepts. They're identical actions with different marketing. Raise margins and you reduce purchasing power. You force position closures. You alter flow patterns. You modify prices. Silver habitually sees this tool deployed at the most vulnerable moments. Let's discuss history because history functions as the warning label nobody reads. Silver reaches parabolic heights, then rules tighten. Restrictions and margin adjustments strike. Rallies break. Stories become cautionary tales rather than scarcity narratives. Silver ripped during post-crisis monetary expansion. As it approached peaks, margins increased repeatedly within short windows. Markets got squeezed. Moves reversed harshly. Now, late 2025, silver surges again. Then margins rise more than once within the same month, with latest increases taking effect precisely as markets thin. Is that conclusive proof? No. I'm not here making accusations. I'm explaining incentives and mechanics because incentives matter fundamentally. When markets are heavily short by major institutions, sharp rallies can damage them. Margin increases forcing long liquidation can provide relief. They create windows for covering. They purchase time. That doesn't require conspiracy theories. It requires basic human psychology. When experiencing stress, you want relief. So ask yourself, when waves of forced selling hit, who benefits first? Forced sellers lose control. Cash buyers gain control. Now let's read today's action like forensic evidence. The crucial clue is velocity. Genuine fundamental shifts rarely happen in 15-minute avalanches. Physical demand doesn't evaporate during coffee breaks. Mines don't triple output before lunch, but paper can move that rapidly because paper represents claims. Claims can be created, traded, dumped, and flipped at algorithmic speeds. That's why futures pricing can drop sharply without meaningful real-world changes. That's why you must separate paper pricing from physical conditions. Here's what typically happens during margin flushes. Paper pricing drops, headlines scream, social media panics, then you examine physical markets. Coins, bars, wholesale premiums often don't follow identically. Sometimes premiums widen, sometimes dealers maintain pricing, sometimes inventory tightens because buyers rush scooping discounted metal. That divergence guarantees nothing, but signals something important. If silver truly became less valuable overnight, physical sellers would undercut competitors moving product. You'd witness desperation. Instead, you often see firmness that tells you something crucial. This wasn't the world rejecting silver. This was leverage getting purged. Why does purging matter? Because it changes who holds exposure afterward. Leverage is fragile. It's powerful upward, but shatters when rules tighten. When leveraged longs get flushed, markets often transfer ownership from weak hands to strong hands. Cash buyers, long-term holders, end users, and physical accumulators. That's why margin crashes can be simultaneously terrifying and constructive. Terrifying because they're violent. Constructive because they clear unstable positions that could be forced out again. Here's today's cliffhanger. Today's drop might not signal trend changes. It might represent purging before the next advance, because purging doesn't repair underlying fundamentals. It was a rules event. Let's put patterns under microscopes, because silver possesses unique talent. It teaches identical lessons across different decades. In the 1980 episode, pricing didn't simply decide reversing. Market rules tightened into rallies. Purchasing power got restricted, and those most exposed to leverage got hit first. Stories later became about greed and speculation. But mechanisms were mechanical. Change terms, force exits. In 2011, you witnessed similar rhythms. Silver surged, volatility spiked, and margin requirements rose repeatedly within short spans. Each increase forced some traders out. Each forced exit added fuel to subsequent drops. It wasn't one sell-off, it was a sequence of squeezes. That's why the phrase, "they did it once more," matters. Not as drama, but as navigation. Because knowing the map stops surprises. And here's where maps lead. If physical markets stay constrained, markets can split. You can have paper pricing getting shoved around by leverage rules and physical pricing staying stubborn, because real buyers keep bidding for real metal. When splits become wide enough, they force resolution. Either paper rises meeting physical, or physical availability dries up and premiums explode. Both outcomes are uncomfortable for anyone needing metal. Both outcomes oppose what today's headlines imply. That's why drops can be deceptive. They can be the system screaming for relief, while physical markets quietly say they still need ounces. Don't let one margin memo rewrite bigger stories in your head. Let it rewrite your understanding of battlefields. Because silver isn't only a commodity, it's a stress test of trust. Every margin increase is exchanges admitting one thing without speaking it aloud. When markets run too hot, leverage becomes the danger, not the metal. Fundamentals are parts no bulletin can rewrite. Silver isn't just monetary metal, it's a strategic industrial input. Solar uses it for conductivity and reliability. EVs use it in power electronics, contacts, and charging systems. Data centers and electronics use it in connectors and high-performance components. Grid upgrade cycles use it in switching and control systems. Demand isn't a meme. It's embedded in hardware. Now examine supply. Most silver supply comes as byproduct from other mining: copper, zinc, lead, gold. That means silver production doesn't respond quickly to pricing. If silver doubles, it doesn't instantly double mine supply. Pipelines are slow. Permitting is slow, capital expenditure is slow, ore grades decline, politics intervene. So deficits matter. When the world consumes more than it produces, inventory gets drawn down. When inventory gets drawn down, systems become fragile. In fragile systems, paper events become more violent because there's less cushion. That's the structural setup. Now add geography and policy, because silver doesn't exist in vacuums. Large chunks of refining and manufacturing sit in Asia. Large chunks of industrial demand sit in Asia. When physical metal flows toward end users, it stops being available, satisfying paper promises. If major exporting jurisdictions tighten rules or prioritize domestic industry, global availability can tighten further. That doesn't appear instantly in futures candles. It appears later in delivery stress, premiums, and inventory drains. This is why silver can look calm in pricing yet remain tense underneath. Now let's address the question people always ask after days like this. Does this mean rallies were fake? No, it means rallies were leveraged. Leveraged rallies are vulnerable to margin shocks, bullish or bearish by itself. It's a market structure feature. The real question becomes what happens after leverage gets shaken out. That depends on whether physical demand remains strong and whether inventories continue tightening. Those are signals you should watch, not hot takes. Here are 4 signals that matter more than today's candle. 1. Physical premiums. If paper pricing drops but premiums don't, physical markets tell you metal is still wanted. 2. Inventory levels at major warehouses and exchanges, not rumors but ounces. Are they draining, steady, or rebuilding? 3. Delivery behavior. Are more contracts standing, rolling, or demanding metal? Delivery demand is where paper stories collide with reality. 4. Global price alignment. If different regions price physical higher than U.S. futures, arbitrage will try closing gaps. Arbitrage is the leash on distortion. Let me get practical about what today teaches regarding risk. If you are leveraged, you learn the most expensive lesson in commodities. You can be right on fundamentals yet still get destroyed by mechanics because markets can force you out before you're proven right. If you were unleveraged or physical, you learn different lessons. Volatility is noise unless it changes real supply-demand pictures. That brings us to psychological warfare following margin events. Banks and big players don't need you believing silver is dead forever. They only need you panicking long enough to sell into holes. You'll see narrative flips instantly. Bubble popped, speculators washed out. Top is in. They'll speak with certainty because certainty sells. But certainty is usually artificial. Don't anchor your brain to one day's price action, especially when you can point to mechanical causes instead. Anchor to setups. Did margin increases create more silver underground? No. Did margin increases reduce solar production? No. Did margin increases erase industrial demand? No. They changed collateral rules. That's it. If setups are unchanged, real questions are timing, not direction. I'm going to ask 2 questions, and I want honest answers in comments. Do you think these margin increases are purely risk control, or do they also function as pressure valves when rallies threaten big short positions? Second, when paper drops but physical stays firm, which market do you trust more? Screen pricing or real-world pricing people actually pay? Answer those and read replies. You'll learn how different people think. Now, what should you expect next? Expect volatility. After forced liquidation, markets often whipsaw. They bounce hard, then dip again. They test nerves, they hunt stops. They punish anyone thinking one move means certainty. Expect attempts shaking confidence, because confidence is the commodity being traded right now. Expect opportunity to appear where fear concentrates. If and only if physical signals stay tight, this is where patience becomes an edge, because majorities are emotional, oversized, and reactive. They sell lows because charts feel like pain. Disciplined buyers do opposites. Disciplined buyers watch constraints, not candles. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is yours, but I'm telling you what today actually was. It was a rules event. Rules events are where silver separates amateurs from professionals. Amateurs think pricing equals truth. Professionals know pricing can be pushed by structure, especially in small markets like silver. Silver is small, that's why it's explosive. In small markets, minimal forced selling can smash pricing. Minimal real buying can send it flying. That's the beast nature. Here's the clean summary. Silver fell today because exchanges raised margins today, forcing leveraged longs to liquidate. Moves look dramatic because thin liquidity amplifies cascades. Moves didn't change supply and demand fundamentals. Moves exposed leverage fragility in this market. The next chapter will be written by physical signals, premiums, inventories, delivery behavior, and global price alignment, not by loudest headlines. If you want the next breakdown the moment something like this hits again, make sure to like this video and subscribe to Mind to Focus. These rule shifts don't come with warnings, and they rarely happen only once. Last question. Tell me straight in the comments below.